So start in 3-4 minutes.
Yeah. Attendees हो गया 3. Okay. Good. 7, 9.
Welcome friends to this webinar. We will start in a couple of minutes. Please bear with us till then. Thank you. Good afternoon, friends, and welcome to this webinar. This is the fourth of our series of webinars, and I hope you are finding a lot of value from what we are trying to bring to you. So today we have two panelists. One is Mr. Bhushan Shah, and second is Narendra Mahajani. I will give you a quick introduction to both of them before I hand over the session to them. So first, Bhushan is a veteran in the financial markets. He has over 3 decades of career experience in financial markets. One who has witnessed transformation of markets from the outcry system in the BSE ring to digital mobile-based trading platform of today. He heads the portfolio of corporates and PCG Group at Ventura Securities Limited. He is with us today to clarify any doubts on the nitty-gritty of market workings and can give you a great insight into market workings. The second panelist today is Narendra Mahajani. Narendra is a veteran of the finance industry. He spent more than 15 years in corporates. He finally decided to switch to consultancy and move to the other side of the table. Narendra brings with him 25 years of experience. He is a rank-holding cost accountant and a chartered accountant by profession. His ability to find simple solutions to complex problems sets him apart from the rest. He is also a popular speaker who has a knack of explaining complex issues in finance through examples of Sholay and cricket. Without taking much time, friends, I will ask Narendra to take guard and bat through this session. Hopefully, he will be able to navigate through your bouncers in the Q&A section. Over to Narendra.
Thank you, Manish, for the kind words. Good evening, everybody who has joined today for this webinar. I hope you all are safe and uh, working from home and managing your businesses and very good spirit. So today, this particular webinar, we are bringing in connection with current situation where the facilities or banks, etc., are working with limited capacities. So we hedge generally the forex risk in three types of markets. One is domestic OTC market, which is banks. Second is overseas market, or it's called as non-derivative forwards. Predominantly, this is used by FIIs and companies who are having overseas setup or subsidiaries. And the third is Indian exchanges, which is NSE, BSE, and Metropolitan, who have currency derivative segment. And my today's topic is related to this third segment. The currency trading started on Indian exchanges way back in 2008. The three exchanges simultaneously started their operations. They have 2,000 members, and this whole business is regulated by SEBI. Of course, RBI is a watchdog on all the trades which happen on currency exchanges. Currency exchanges trade generally futures contracts, which are 12 monthly contracts expiring every month. Then there are options which are having a blend of monthly contracts as well as weekly contracts. And the pairs which they trade USD INR, Euro INR, GBP INR, and JPY INR. Also, now there are crosses also available for trading on currency exchanges. And the settlement of this trade happened on our last day, and that is expiry day at 12:30 p.m. as per RBI reference rate. Now, having known these exchanges for almost 12 years, what is the purpose of today's webinar? Why we are discussing this? Because all these exchanges had been around for quite some time, and many people must have taken the benefit. They have already used this platform sometime or the other, or they are regularly using it. So I would like to say some USPs of currency futures in today's webinar. COVID-19 has created a lot of change in the way we handle the business. So one of the prominent change which has happened is RBI has reduced the timings for OTC market from 10 to 2. So morning 10 a.m. to 2 p.m. is the market timing today. But exchanges still open from 9 o'clock to 5 o'clock. What does it mean is whatever events happen before 10 o'clock or after 2 o'clock, you can always take your position in Forex market via exchange accounts. So though the business has got affected due to the less timings or fewer hours of trade in OTC market, those are getting compensated, or there is an avenue to trade outside the OTC platform and do the hedging. Exchanges give margin-based exposure, unlike the banks or OTC. In banks, you have to apply for hedging limits and you get it. The problem which many corporates witnessed in the month of February, March is with especially Yes Bank. So clients had the limits with Yes Bank, but due to problems, they were unable to use those limits and they were handicapped. They were unable to hedge their exposure in through Yes Bank. So exchanges platform, that is a very simple exposure management system where you get limit and your limit is based on your margin. So there is an upper cap of the limit which is fixed by the regulators, but within that there is no separate documentation or application. You place the margin and you start. So in such circumstances, as I explained, the exchange platform becomes handy. It is absolutely ease of trading is available in exchange. Most of the exchange trading platforms are electronic. Today, everybody is accessing the markets through net-based or mobile-based apps. So you can do the trading by traditional methods like you do in OTC call and trade, as well as you have option to trade electronically by directly logging onto the system. Exchanges provide very fine bid ask. After the 2 3 slides, I will show you the actual exchange screen. So like we talk about the market rates like quarter paise, exactly those rates are available in exchange traded contracts, and your that rate becomes your dealt rate. Minimal documentation is the one of the biggest USP of exchanges. Generally, when you hedge in banks, it is to be backed by a lot of documentation. You have to submit your order copies of imports, exports, actual bills, etc. Here, no such questions are asked. It is a very simple margin-based trading system. Once you have set the margin and within the limits, you can do any number of trades. No questions are asked by the exchange. You can start with a very small amount, that is $1,000. Means a smallest exporter of even say $30,000, $40,000 exposure also can trade. And the beauty is, one who trades $1,000 or one who trades $1 million, the rate they get is the same, subject to little bit liquidity movement, but there is no differentiation for small buyer and a big buyer. Like generally you find with banks, the rates are quoted differently for large customers and small customers. Exchange gives uniform rates for everybody. There is no delivery on the exchange. So what does it mean? That at the month end, you can roll over your exposure to the next month. It is by just doing a reverse trade in the first month and again taking a position in the next month. So suppose you have hedged your imports, that means you have bought dollars in the month of May. And in this month, you don't have to make the payment. It has got switched to say next month because your shipment has got delayed or whatever. Or when you booked, you are not exactly knowing whether your exposure will come in this month or next month. You are taken position in May. It is very easy to roll over to the next month by just selling in month of May and buying in the month of June. Exchange also generates a lot of arbitrage opportunities because of timing, mismatch, etc. So many times you will find over OTC market, there is a premium or a discount, which lasts for a few hours or few minutes. You can take the benefit. Today, what is happening is when the market, OTC markets close at 2 o'clock, you will find there are a lot of movements happening in exchange traded rupee dollar contract because of like say last 2 days. There is a speech by a press conference by the finance minister today. Also at 4 o'clock, she is going to speak on further packages. So based on that, market will take a clue and market will start quoting rupee dollar rates or other currency rates accordingly. So like you say that if there is going to cause a lot of burden to Indian economy, rupee may start weakening, or market feels that it is not that big burden, rupee may start appreciating. In OTC market, the window will be closed that time. You can always use these arbitrage opportunities available at times. Exchanges do daily mark-to-market settlements. So your account is closed or account is position is known at the end of the day. There is overall capping of limit. Currently, it is around $15 million per client per exchange. So approximately one can take a position up to $45 million with all three exchanges put together. The exchange screen, it is very much similar to the equity market screen, where one can have a complete view of the market, the buyers and sellers available, what is the open interest, what are the rates available at various contracts or various quantities available at various rates. All these things are available transparently to everybody. So this makes exchange a very, very popular mechanism worldwide. So in OTC market, there is a little differentiation. Banks give you quotes and you either say you trade at this rate or not. Exchange will give you open rates. It is available on the screen and you decide whether to execute a trade at that rate or not. There is a further legal mechanism available for exchanges that SEBI being a regulator, there is an arbitration facility. So any trade which is disputed goes into SEBI mechanism. So this is just for your information. Exchanges do big volume today. It's approximately $1 billion volume happens every day. Open interest is up to $2 billion. Now what I will do is I will request Kubir to share a market screen.
Narendraji, just I want to make one small correction.
Yes.
The client-wise limit on the exchange is 100 million.
Okay. Okay.
So not 15 million.
Okay. Oh, it's a lot. Yeah, so gentlemen, you can see the live screen of the market. So 2 o'clock, the OTC market closed, but exchange platform, it is showing live market. You can see those flicks which are happening. Rupee is quoted, May end is quoting at 75.73, 73.25. That's what I said. The fine bid ask is quarter paisa. And that's exactly the rate at which you can deal. Okay. The small window which has opened on your screen shows the book. So on buyer side, you will see 1,52,000 contracts are available for buy and 100,766 contracts are available for sale. And the gap, if you see, every time it is quarter paisa. So the first buyer is at 72.75 and the last is 71.75. So within just 2 paisa gap, there are about 2,000 to 3,000 contracts available for buy or sale. So this is the kind of liquidity exchange is having, and one can leave market order or one can leave a rate order. It is up to the customer. Exchange gives all the facilities. You can keep the order till the day end. If the rate arrives, you will order will get hit. There is a stop loss mechanism. So all possible trading features are available on the exchange. So like USD INR contract, here the screen shows next 2 months contract. You will see the premiums which are prevailing. They are at par with OTC market. Okay. In exchange, you also have other pairs like Euro GBP. There also you will find the Euro rate is 81.84 and 81.85. So 1 paisa quote for GBP contract is a very, very efficient quote. Now exchange also gives a lot of opportunities to trade in options contract. So options, as I said, they are available on for month as well as for week. And there also you can have a lot of strategies, like you can have one trade which is based on, say, your view. Suppose you have imports, you have purchased dollar and you want to put a stop loss, you can have a reverse trade available through options. Now where you can actually use exchange, many times suppose you are having a position which has been completely hedged in your bank, but due to some or the other reason, some of your business problems or whatever, you don't want to go as per that schedule, but you are also not, you also don't want to cancel that contract. You can have a opposite position on the exchange. Okay, so you have purchased dollars in bank. Here you can have sell contracts, so you can neutralize your trades by using this alternate platform. As I said, the limits are based on your margin. So there is no restrictions whether your hedge is on your buy side or side, though the purpose of this seminar is only hedging. But in exchange, when you trade, you don't have to disclose your export orders or import orders or which side of the market you are actually, you are free to trade anyway. So it should not amount to speculation as far as a corporate is concerned, but as a regulator or as an exchange, this question is never asked. Okay, so these are the primary features. Of course, as a market, it is known to everybody. My purpose was to give some feedback about current COVID scenario and where you can always take benefit of these exchange traded contracts. I request Bhushan to give a view on the these markets as well as his perspective, and he will also give answers to your questions. Bhushan, unmute yourself. Unmute.
Sorry, yeah. So good afternoon, everybody. Thank you all for taking the time out to attend this webinar. It is always a pleasure to listen to Mr. Mahajani and obviously Mr. Manish. A brief background about Ventura Securities. We've been in the financial service sector since way back in 1994. Mr. Ahmed Majitia is our CEO. He's a co-promoter of the company along with Mr. Sajid Malik. He's also the other co-promoter of this company. The two of them together had this vision, and today they've built Ventura with a a team of more than about 1,500 people, and with a pan-India presence of more than 300,000 customers. everywhere, like, having said that, every platform, anything that is electronically and officially traded on any platform on the country is what we provide on our platform. Our trading platform is our core business, the online trading platform. Having said that, a view on the market, I believe Mr. Thanawala is the best authority to give us a view on what would be the reactions and what is the way forward here with the finance minister, with the budget, I mean, with the numbers that the Prime Minister has mentioned, and all these packages and all. Mr. Thanawala, just one thing. If you have any questions regarding to opening an account with Ventura and doing your trade and ensuring that you can hedge your foreign exposures, please feel free. We've left the details on this thing. You could get in touch with any of us over here, and we would love to be able to help you open your account in these times. Obviously, these are difficult times, but we will be able to do it. We'll see how we can take it forward. God bless technology when I say that. So, Mr. Thanawala, if you could please, Manish.
Yeah, Bhushan, thanks. So while the markets have been choppy and the hours have been truncated, currency has also been swinging. So we have both positives and negatives for currency. The biggest positive today is the oil prices, which has dramatically dipped and which could significantly narrow our current account deficit. So that is a huge positive for India. On the negatives, we have the FI is exiting India, and we have seen a huge amount of outflow. And obviously, the worst is probably behind us. And now that most of the people having withdrawn, I think going forward, we may see an increase in inflows rather than outflows. So on the short term, the way I look at it is rupees trading within a tight band of 75.20 to 76.40. And I think people should take advantage of this band and use the currency to actually take play both sides of the market. The immediate strategy we are telling importers is that please look at buying when you reach the lower end of the band. Exporters, we say that probably you may have further 3 months forward premium which you can capture, or a 1 year premium which is around 3 rupees which you can capture. So on upticks, when you are getting more than 79.50, probably for 1 year, it's probably a good level to sell. So this is where we look at dollar rupee on an immediate basis. Of course, volatility is the day of the game, and we would see a lot of movement in currency to go. So it will keep giving you opportunities both in and out. Plus, there'll be a lot of arbitrage opportunities. There are times where we see that the exchange trades above the OTC, and there was a time around 31st March where the gap was as large as 1 rupee. So I would strongly recommend customers to look at both the exchange and the OTC markets and capitalize on the gap, because this is free money, and any money that you get without taking risk is a bonus. So I think there are huge opportunities that keep coming up with the exchange and with the gap between the exchange and the OTC, which is something that everybody can track. So I would actually now request anybody who has any questions to please put in questions on the Q&A section, and we would be more than happy to answer those questions if you have any. So we look forward to the Q&A questions. And by the time you guys put up questions, a lot of people have one simple question which I will request Mr. Bhushan to answer, is that what happens if in this situation I do not have an account opened and I want to get an account opened? Is there a facility that is available with you guys where we can actually open the account even during this lockdown period? Bhushan, if you can address that.
Account opening is today, it is more about compliance. It's more about going through the rules and regulations that have been prescribed by SEBI. So obviously there are a lot of documents which have to be addressed and which have to be attended to. Having said that, we have a team of people who would be able to do things, come down to your place personally and pick up the documents if necessary, because there are a lot of, if it is an individual account, you can do the whole thing completely online. But if it is a non-individual account, if it is a corporate account or an entity, then there would be a little more questions, more documents that would be required. So we have a team of people who would actually personally come down and ensure that everything is done. I mean, in these times, we'll definitely ensure that the accounts will be opened. That shouldn't be a problem at all. But it has to be a case-to-case basis. Like each individual guy would have a different problem, like a different issue to be addressed, like. Right?
Thanks, Bhushan. So
Right.
I have one question with one gentleman from Modi Timber. He says he is an importer and he wants to ask whether 3 months down the line should he hedge or not. Narendra, would you want to address that?
Yeah, I think he should hedge. But what happens is the futures contract may not suit him because currently the sentiment is going towards positive. He can select a suitable options contract, whatever strike price is comfortable, and take a hedge position for imports. Because whatever the stimulus is being given, currently market has not reacted much, but anytime suppose market feels that there is going to be inflationary pressure on the economy, rupee may have weakening zone, as even Manish also gave the view. So I think importers currently should look into options contract, okay, and exporters should take the benefit of the premium by selling in futures.
Another question is hedging required for net importers for 9 months? Subbu, do you want to answer this question?
What was the question, Manish?
Is hedging required for net exporters for the next 9 months?
See, I think 9 months is too far away. I think more focus should be on the near term, and we would like to look at import being covered for the shorter term. And as Manish mentioned, the range of 75.20 to 76. At the near end, top end of the range, you could look at selling the exports even 9 months because the premiums are attractive. And I think all the negatives have already got factored, and outflows are over. Now only we may see inflows on account of this FI coming back and the bigger flows from the Reliance rights issue and also their disinvestment on the Jio. Those will add money and rupee could appreciate as we go forward. But next 1-2 months is going to be tricky, and it's always better to be long on the shorter end of the tenors.
Okay. We have another question from Mr. Asit Parekh. He says, we are an EPC company. We are pitching in for projects outside India and the receivables would be in USD, but our procurement is in multiple currencies, mainly in dollar, euro and Hong Kong dollar. What cross-currency ratio should we take into account, assuming we are awarded the contract in June and our actual procurement begins in December till April 21? Subbu, you want to take that question?
Yeah, I will take that. See, I think you have multiple currencies, and in all the currencies, you have the dollar rupee leg embedded. I think the euro may not be in a rush to appreciate, and we are seeing the economy slowing down, and also that euro may be in this range. So it's better that you focus more on the dollar rupee leg initially, and of course your payments start from September or something. So what you could do is take a level of maybe 75-20 or any of that level and cover the dollar rupee leg, and maybe the dollar to euro leg you could postpone at some point when you see a correction. So ideally splitting the contracts into two legs can be done on the OTC, but on the exchange you get a euro rupee rate, so you could also cover the euro rupee rate as you get closer on a structured way of depending once your payment schedules are frozen. 6 months is little far away. Maybe you can get opportunities of dips and take advantage of that.
Any other questions, gentlemen? Please type in the Q&A window. So while people, so one more question from Vishal Jain. We are a net exporter. Is it a right time to take forwards or option by paying premium? Narendra, will you want to answer this question, please?
Yeah, I think in consistency with the earlier answer, I would say exporter should go with plain futures contract or forwards, and they should grab the premium which is available. At some point, you may come across a situation that rupee appreciation is getting capped. You can either exit or build an option position in that case. But exporters should try to capture the premium in current scenario.
I just, if I could add a couple bits in front of the three stalwarts that are here. Most of the questions was specific for a situation whether I should hedge or no. That was the crux of it. My 2 bits on this is my core business is very, very clear. I don't want to be exposed to any other additional risk such as currency risk. So should I hedge is a no-brainer. I mean, hedge to karna hi karna hai. That's the way I see it. Like, I don't want to earn money out of currency fluctuations. I definitely don't want to lose money out of currency fluctuations. Hedge, yes. How? What is the right mechanism? Under what guidance and advice is the way to take it forward? Like so we have another question here, sir.
Yeah.
So I think this also Bhushan can take.
Yes. So this for you, Bhushan, is what are the advantages of options vis-a-vis forwards?
Options versus forwards.
Or futures, you can say.
Options, your risks are obviously limited to the premium amount. Of buying options is like buying insurance. It's as simple as that. Forwards or futures, as we say, they are volatile, they are fluctuating. You'll constantly be exposed to mark-to-market margins. But it's a very case-specific thing. What is the right thing to do at what point of time? So there is nothing which is better or worse. Options can also be used in various strategies that you can think of, like how you can hedge your position and create the right book for you. So it's a very tricky question in the sense, difficult answer. What is better depends on what situation you are in at what point of time.
I would like to add to what Bhushan says. See, option and futures or forward, as you call it, is a function of the tenors also. Sometimes the shorter end, the option may not be workable because the pricing of the option or the option premiums are very high. Far term, if you're looking at any payable or receivable beyond 6 months or a 9 month, like an EPC contract, where the tenors and events like this keep coming in, options sometimes is better. From the angle that it works as a protection and a participation. That means if the market goes against you, you are protected, and if the market reverses, the maximum cost to the option premium and any upside move can be taken advantage of. So I think both have its own pluses and minuses. You have to decide between the tenors and also the type of transaction for which you are taking the hedge.
So there is another question that is for Bhushan to address. What are the cost of opening an account with Ventura?
There is a brokerage charge that happens. That's all on every transaction. And it's the factor, which is absolutely at par with anybody in the industry.
I think opening account. He's saying opening account.
For opening an account.
Account is, there is no charge involved. There probably would be some nominal demat account opening charges, but there's nothing else involved. Yes,
so
there's
for currencies, there is no demat also. So I think only
there's nothing. Nothing. Practically no. To open an account, there's nothing. It's just the paperwork and the time that's involved.
Okay.
Opening an account is free. I think that is exactly what Bhushan is trying to say. And he just was probably worried that if he says it's free, everybody will just open the account. And I strongly recommend that everybody open an account. because you don't know when the opportunity will come knocking. So it is always good to have an account with you, and you cannot wait for the opportunity that now I need to open an account. It is better to be ready than to regret when the opportunity comes. Next question from Mr. Patabi Raman again for Bhushan. What is the normal margin requirements?
Margins typically are a factor of the fluctuation. They are determined by the exchange itself. Exchange has its own parameters. They have span margin and gross exposure margin and things of that sort. But motor, you can consider it's about 3% of the value like, of the
So
transaction.
Bhushan, on a $100,000, what will be a rupee value of the margin?
It's 3%. So it's about 30,000 rupees, I believe, right?
Yeah.
Yeah. Gives you an idea. So
This is a
100,000.
ballpark figure. I mean, it is decided by the exchange usually. Right?
So what actually it boils down to is for the 100,000 position, you need 30,000 rupees to take position. Next question is hedging beneficial if the import payments are due in the month of July or August? Subho?
Unmute.
Sorry, see the next 2 months are going to be again uncertain, and we are going to see volatility. So volatility is the game. So the first thing you have to look at is what benchmark or what is the rate you are trying to protect. That is the most important driver for any hedging, because if the currency moves again, that you are going to incur loss due to the currency. So coming to the July August, yes, it is we are 3 months, and the rupee range what we mentioned is between the 75.20 to 76. So if at all you are getting an effective rate within 75.80 or 75.60, maybe at 40-50 paisa premium or at the bottom end of the level, you should start looking at covering. But definitely, as you keep getting closer at any point of time, and in today's scenario, it's better to be hedged for at least 2 months, because your 2 months time market may give an opportunity. So on a rolling basis, you should be covered at least 2 months.
I think we'll wait for a couple of minutes for people to type in questions.
Yeah, I think one question is coming on.
There is a question on the chat.
Yeah, so there's another question for you, Bhushan, before I take the question on the chat. Initial margin in any format like cash or FD, daily margin in which format?
I'll answer that question. 1 second. Clearing.
So I'll repeat the question if you want. Initial margin in any format like cash or FD, question, or daily margin in which, how do you want your daily margin?
Daily margin, see, the margins are taken in various forms which are prescribed by the exchange. You could have, 1 second. You could have also give it to us in collaterals, like, okay. There's a specified list by the exchange which we would share with you, and yeah. So just a moment. I'll just. The exchange accepts various collaterals which we can share with you when we connect with you directly.
Sure. Okay. Next question probably is for Subho. How would you guide on rupee movement vis-a-vis USD in the coming 3, 9, and 12 months from now?
I think the rupee is going to be choppy, because it's going to be a function of 2 things: the flows and the measures announced by the government to take care of this situation. Of course, the overall outlook is negative. All parameters have gone for a toss. Fiscal deficit is going to go for a toss. The trade deficit may be positive because crude prices have dropped, but I think considering the pressures, I think the outlook on the rupee will be negative with a slight correction. So as I mentioned, you have to trade in the range and take advantage of both end of the levels. And RBI may intervene. We have seen situation when RBI comes in at the extreme end of the ranges. So if it tries to sharply depreciate, the reserves are very robust now. RBI may intervene, but definitely you have to take a call of continuously monitoring and keeping hedging. I think the head decision has to be more proactive in the next 3 months than what it was, because the outlook is going to be a little more bearish, and if the lockdown continues sometime, or if any second wave like thing comes, I think we are in for pain. So the importers are to be more focused and cover their payables on the short term range of the exposures.
Next question is for you, Narendra. The rate of the exchange and the bank rate will be separate, and they are two separate transactions, correct? Yeah, I think yes, they are two separate transactions. Then there is going to be a delta, and how the company does not lose money. Also, can one take a specific due date?
Okay, so there are multiple questions. So when it comes to exchange, the contracts have fixed maturity date. They are futures contract, not like forwards. In forwards, you can have any date. Futures, it is the date which is fixed by the exchange or the regulator. So futures, it will close on the month end date. Options, you have two different scenarios, either monthly contract or a weekly contract. The pricing, see, exchanges are mirror trading sites. So the rate for the month end will be calculated based on the rates quoted in OTC market. Okay, so the rate has to be the same. There will not be frequent arbitrage opportunities. Sometimes they do prevail, but on the expiry date, the contract, as I said, is closed as per RBI reference rate prevailing on that day at 12:30 p.m. So expiry has to happen as per RBI rate. There is no two separate rates. Now, how the company should not lose the money, that's what your contention. I think I need to understand the transaction more in detail. We can take that offline. My number is given over there. We can speak, or Manish or Subbu, anybody on of us, and we will answer your question. Manish, this question is for you. Why all global trade is done in US dollar? your favorite topic.
See, unfortunately, all global commodities are priced in US dollars. So if you look at the base metals, you look at agri commodities, you look at gold, you look at silver, you look at crude, you look at edible oil, everything is in dollars. Now, because everything is priced out of dollars, obviously the one part of or counterpart for all currency transactions will be US dollar. And that is why around 80% of the trade in the world is currently done in US dollar. And that is why dollar rules and the US rules global markets. It is the pricing which happens with that dollar which actually contributes to this.
Is rather their dominance in trade for last 50 post Second World War. Dollar had been the currency of trade.
Manish, there was one question on the chat by Mr. Modi Timber. He's an importer and want to ask, down the line 3 months, should we hedge or not? Our imports were at 72.
Well, my dear friend, we are already way off the market. So I think by not hedging, you have already lost a lot of money. So you have to now mentally think of how much more is your appetite to lose. And at one point of time, you may have to say that, okay, beyond this, I cannot take a call and I'll have to hedge. So it all depends now on your risk appetite. So I think we have broadly given the range for the rupee. We immediately in the short term think the rupee is going to be in the range of around 75.20 to 76.20, which is a very tight 1 rupee range to give. And also we are saying that there is a bias on the weaker side for the currency. Obviously, if that is our view, then we would say that if you see ticks to 75.20 or around near 75.20, you can look at hedging your position. Now, here I would like to also, put in another thing. You have taken a risk from 72, and though it is my view that rupee may not go below 75.20. Obviously, there is a possibility I can be wrong. And even if there is a 10% chance that I'm wrong, in that case, you might use an option to hedge because your tenor is short term. Keep paying 1 month premium. And as long as you're protecting yourself, you can keep rolling over the contract. And that way, enjoy the benefits of a sharp appreciation and also protect yourself from a further depreciation. So I think that is how you would tend to do things.
See, I can add here if you have an appetite to extend this liability, because now normally people are importers who have such a situation where the rupee is depreciated beyond their costing rate. They are looking at rolling over this liability for 6 months. Basically the advantage is, the 6 months or 3 months beyond the due date. In that case, if situations improve, that's a possibility that rupee may correct. You may buy time also. The cost of doing that is definitely lower than the INR cost of funds. So if you want to look at that option, we can discuss and give you options on how that will work. So maybe you can get a time to defer the liability and wait for rupee to slight correct downward, and to make up or reduce this mark-to-market loss at today's levels.
There's another question from Mr. Hansraj Kapoor. Euro INR and GBP INR are traded in a very thin and odd rates on NSE. Narendra, you or Bhushan, you would like to comment on that?
I think, see, as far as rates are concerned, it is always in the line with OTC. As I said, the bid ask is always fine on exchange. There is absolutely no doubt about that. The depth may be a problem at times if there are not enough buyers and sellers. The execution of large quantity may have a problem, but always and always rates are in parity with OTC. But since you have pointed out, I will again go back and have a look at the screen and I'll see what actually is happening. One thing I'll tell you, even for large trades, exchange facilitates, there are counterparties available like banks. So if a exchange participant has a large order to execute, and that time if the rates are not available, one can always call Mr. Bhushan and they can speak to the counterparty and the rates can be made available, because even banks also want to trade a good number of contracts over here.
I would only like to add one more thing to that. Is at maturity, everything else has to converge. So if there is a gap, then the best thing is to arbitrage. I think we should be happy seeing a gap if there is a gap. And so there was a huge arbitrage that was happening in April, beginning April, end March, on dollar rupee first, then euro dollar, GBP dollar, GBP INR contract. And obviously there was clear mispricing on the exchange. So that are opportunities for you to take advantage of and arbitrage.
Yeah, rightly said, Manish. It is an opportunity. If there is, because arbitrage should not last for a long time. Whenever you see such opportunity, and provided there is good quantity available either for buy or sell, you have a counter leg with OTC. You actually grab this opportunity. That's how the arbitrage reduces.
The next question is, are there any rules and regulations for any country for printing currency? Narendra, you want to answer this?
Yeah, Manish, you address that.
No, I would like to keep myself quiet on this.
Okay.
So
okay.
Unfortunately, I am not in ink business. I would have been happy if I would have been in ink business.
Okay. Jokes apart, I think, the currencies which are printed should have some collateral or backing beyond which they can't print. I think the country normally uses their gold reserves or something to link to the amount of currency they print, because this is a deficit financing, and any amount printed more than what is warranted, it will lead to too much money chasing too few goods, and which will create a inflationary like situation. So I think definitely the guidelines are prescribed onto the macro. In fact, today there was a news where the government was willing to buy gold from the people and use that gold as a collateral and then print more, notes. So definitely the gold, any printing done has to be backed by some collateral, and it cannot be printed just out of the air.
I will just add one more line to what Subbu said. See, theoretically, we know printing should not happen, or excess printing is not good for the economy. Today, it is the scenario in COVID when every economy is in trouble. Everybody is resorting to the same thing. So who is printing more and who is printing less is the criteria.
So let us move ahead. The next question is there a way to hedge for indirect cost increases as vendor imports and sells to us? Honestly, I didn't get the question.
No, Manish, I got it. Basically, the vendor is importing and then possibly selling them in INR. So what's happening? Whatever currency risk he is taking gets passed on to the price where he sells locally. So I think it can be a proxy hedging. Like, if you know that the vendor is buying, the company who's the end customer or buyer, he can hedge the currency on the exchange because though he may not have direct underlying to hedge, he can hedge it on the exchange as a proxy hedging to offset the adverse movement of the currency which the vendor may pass on. I think that's what he's trying to say.
In fact, he can only do on exchange because banks will not allow him to hedge because there is no direct exposure on his balance sheet.
Correct.
Exchanges you can do.
Agreed.
Okay. Next question for Mr. Kapoor is there any exchange active for currencies after 3-4 months period? Bhushan Mahajani, please.
After? Sorry.
Beyond 3 months.
Miss the quote, rupee dollar or whatever quotes. See, contracts are available up to 12 months, but the active rates are for 3 to 4 months. But beyond that, if there is anything, you can call offline. As I said, counterparties are there in the market, especially banks who can give you quote. If you're okay with the quote, it is in line with OTC quotes, you can trade. It's not impossible. Okay, but I'll tell you the drawback. Like in first 3 months, you can exit anytime. That exit may not be possible, but if it is actually against your import, export or foreign currency repayments, you can use this window also. The quotes can be made available.
And it will also work for GBP and Euro also, I guess.
Possibly,
so
yes.
I think Mr. Kapoor, the banks are very active on the exchange also. So each bank like ICICI Bank, State Bank of India also are very active on the exchange platform. So all you need to do is go to your broker and tell them that, I want a counterparty quote for longer tenors. Typically, the bank will give you the same OTC rate through the exchange. So generally, entering is not a problem. Exit can become a challenge. But then the way I would say that you hold it till you come to the nearer months, and then the contracts will become liquid and you will be easily able to exit those contracts.
Absolutely.
So that is probably one way of looking at it.
The next question is for you. I think you're into the derivative. How to calculate the premium for range forward option, plain vanilla option? Because every time we need to go to the bank for option quotes, and is it correct or not? No mechanism.
So the problem that we have today is for pricing options is you need volatility data, you need risk reversals, and you need butterfly. Now, these are typically not actively quoted in the market. There is a market, but it is not so active, and not many players know how to actually price an option. So an option is priced using what is known as a Black-Scholes model or the amended form of the Black-Scholes model. So typically, the inputs to a Black-Scholes model would be interest rate, spot rate, strike rate, and volatility. But when you are pricing an option which is not at the money, in that case you will have to look at a smile adjusted volatility, which is not quoted but will have to be derived through a complex mechanism. So these are tricky things to do. There are there are platforms which are available. In fact, Greenback also has one platform where you can price vanilla options. And if you want to know more about us, get in touch with us. We can probably talk about it. The next question, I think, is from if I hedge from the exchange and not the bank, shall the hedge be counted for currency exposures against outstanding export bills? Narendra?
Exchange and not. Yes, basically, there is one amendment to Income Tax Act few years ago, where recognized stock exchanges word has been added. So that is for whether to treat income as a speculative income or a business income. Having said that, well, the contract, everything you can support is not necessarily that you have to hedge only with bank and that is treated as a valid hedge. It's a government recognized or RBI recognized platform. Okay, so I don't think any problem. It will be recognized as hedged because hedge documentation doesn't say that it has to be done on a bank with a bank.
मैं करता हूँ 2 मिनट में.
So the next question is, how is US printing money in trillions of dollars? Has it been backed by their own collateral security, or does so much demand for dollar globally enable it to do so, and therefore it can supply more money? Narendra?
How can I really don't? We really don't know whether they are printing money. That's what I can say on an open platform, which is boomed everywhere.
So I think every country gets into deficit financing. But as I said or mentioned earlier, a majority of trade is denominated in US dollars, and hence they have more leverage to print currency than probably other countries like India.
I would add one more thing. Whatever we read about in the tagline of trade wars is all about this: who dominates and who is the big one. Okay, we watch, we read because we are yet to reach that level. So the fight is for ultimately that dominance. Whether today it is US dollar, tomorrow whether it will be Chinese or some other currency, we really don't know. So current demand supply, dominance for last 50, 60 years is in favor of US.
So this question definitely for you, Narendra. Do you recommend hedging on the exchange and leave the bank end open?
Yes, because both rates generally, as I said, both rates are same. Now, I mentioned one point that the actual deliveries happen only in bank. Exchange do not handle export and import deliveries, means the payments. The final payment will happen in the bank. So you have to close the leg in exchange by way of a reverse trade. So if you have gone long or hedged imports, you'll have to buy it at the expiry the day you make the payment from the bank. I can very well say that your rates will be efficient. It will be at par with OTC market. You will not have any loss due to trading on exchange from that particular aspect. Rates may go any side. Okay. So exchange platform is far efficient. It is there for last 11 years. Daily, the volumes are close to $1 billion, 70, 80,000 crore rupees. So rate wise, you are okay.
So I would like to add one more thing here. So it is all a function of what kind of service you are getting from your bank. So I have significantly very good customers, AA rated customers who work with both private and international banks, and they here prefer at times to hedge on the exchange because of convenience. They find that it is very time efficient to hedge on the exchange, and that is why they tend to hedge on the exchange. And especially when you are going to be hedging using options, especially for your import short-term buy calls, exchange is far more efficient to enter and exit vis-a-vis bank. Because what typically would happen in a bank is, one, you will haggle with them for a long time for a good price. Secondly, when it comes to exit, you are stuck with them. While in case of an exchange, because it's an open-traded platform, you have a very easy entry and exit. So it is clearly dependent upon the what service you're getting from the bank and what type of trade you want to execute.
See, one more point which marginally expressed was the timing factor. Like in today's scenario, when the banks are open only from 10 to 2, but the exchange is open from 9 to 5, you have a longer time frame within which you can hedge, and even post the banking hours, if you need to, you get a spike or a fall, you can hedge on the exchange. So the flexibility on the exchange is much better, faster, and there's no human intervention. Here you are directly dealing with the screen and you get what you see.
Next question is, we are exporters and the bank regularly asks for quarterly data on foreign exchange. Can the hedging on the exchange be shown in this data? Will the bank accept this?
Yeah.
I will answer this question.
Yeah.
So I think the exchange is recognized by the Reserve Bank of India as a platform to hedge, and I really don't see any reason why the bank will not accept when you include hedges on the exchange as a part of your hedge data. Only thing is they may want a confirmation from the broker of the outstanding position on that date, which I am sure you will be able to provide. So I don't think that's an issue at all. You can definitely show it that way.
Generally, they ask for a CS certificate. So at the quarter end, so if adequate hedging is done or not, so I think CS can certify on the basis of trade certificate or trade contract notes of exchange.
Okay, one more question. Can we not trade in our own currency or opposite country's currency? Is it not allowed?
You can trade in a currency against another opposite currency only. So there should be a pair, currency pair, and the exchange offers you that 5 pairs: dollar, rupee, rupee yen, dollar, rupee euro, rupee pound, rupee yen.
Plus crosses also now available.
Yeah, the crosses also non-INR also.
Yeah, USD euro you can trade.
Yeah.
I think there are no more questions.
So I think Narendra and Bhushan, thank you very much for taking your time out and addressing everybody. I hope, friends, you found it very informative on this session, and probably we will continue our webinar series next week also. And to just give you a recap, we are likely to have Mr. Ramasubramaniam, who is an ex-general manager of the Reserve Bank of India, explain us about the new RBI provisions on foreign exchange from the RBI perspective in light of this COVID period. I would strongly suggest you all register for that. We will open the registration soon. Thank you.
Thank you, friends.
Thank you.
Be safe. Take care. Bye.
Thank you, everybody. Thank you for your time.